Hi, everyone. I'm Mike Basito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. For this July episode, we're going to change it up a bit and do a special edition. We'll still cover monthly performance, attribution, and positioning, but we're going to spend more time talking about what's been happening in the managed futures space this year and what it means more broadly. What we're seeing in 2025 is truly historic, and we believe it represents an undeniable paradigm shift in the asset class that practitioners and allocators, consultants, and analysts now have to look at seriously. We're talking about ramifications to the managed futures space at large, and there are fiduciary considerations as well. So we're going to dive deeper on this and press the issue. Hopefully that wet your whistle, but before we go there, Andrew, let's touch briefly on the month of July in terms of performance and some of your broader macro thoughts.
Thanks, Mike. So last month, I said the markets were decidedly risk on, and this continued in July, with not just another month of gains for equities, but also a bounce in the US dollar. In a sense, the market is settling into a view that investors should tune out to the extent possible the day-to-day noise on the political front and focus on fundamentals, which brings us to the second bullet. It was an interesting month in that the Fed's assessment of the economy, basically strong, seemingly was contradicted a few days later by surprisingly poor labor market data. In other words, we may be at an economic crossroads where the tariff shock and maybe disruption from AI is starting to reverberate through the economy. In CTA land, it was a relatively calm month overall, quite a shift from the second quarter. DBMF modestly underperformed both the SocGen CTA index and Morningstar category, but as Mike is about to remind you, relative performance this year and last has been very, very strong. Back to you, Mike.
Okay, so this is an update to a slide we showed last month. It's every single managed futures strategy, mutual funds, and ETFs in the Morningstar Systematic Trend category. Now you can see where DBMF lands against all of these competitors, as well as against the Morningstar peer group medians. Now the category has always had a high level of single manager dispersion, and followers of DBMF know that narrative well, but we've never seen this level of variance, most of it very negative, between managers in such a short period of time. And our broader contention is that 2025 is just a more pronounced short-term representation of a long-term structural issue. To that point, here's performance of every strategy in the Morningstar Systematic Trend category since inception of DBMF. Look at where DBMF lands compared to each of the competing strategies, as well as versus the SocGen CTA index and the Morningstar peer groups. 2025's incredible performance divergence amongst managers and strategies has accelerated a breaking point that our corner of the investment industry must respond to. And simple reduction in expense ratios may be one part of the equation, but most managers will have to go well beyond that. We believe embracing a lower level of overcomplexity and thus lessening implicit underlying trading costs that may not show up in a prospectus, but certainly show up in performance, will be critical to delivering the long-term structural alpha and the consistent diversification benefit that managed futures should provide for portfolios. And this could also alleviate much of the extreme performance risk like what we've seen this year to date. Andrew, you went deep into this on the last Top Traders Unplugged podcast, but can you take the wheel here and add some thoughts?
Sure. Yeah, actually, the point is really quite simple. The evidence today is quite clear that our replication models are picking up on the same alpha generating signal as CTA hedge funds and mutual funds. The low or zero correlation equities, crisis alpha, etc., but just delivering it more efficiently. Now, so most of you, as sort of Mike alluded to, will compare the expense ratio of DBMF to other mutual funds and ETFs, but this misses a big part of the story. So as I discussed on that podcast, the Voldemort of this industry, the thing that no one wants to talk about, is implementation costs. In other words, explicit and implicit trading costs. Our portfolios are designed to be deliberately efficient. We seek to trade only the deepest and most liquid futures contracts, which means that we can potentially save 200 basis points or more just on implementation. So this is why we believe replication has structurally outperformed both hedge funds and mutual funds by far more than the differential in headline fees. This efficiency advantage is a source of structural alpha. Now, interestingly, there's a good argument that our outperformance in both 2024 and 2025 is attributable to the complexity race in CTA land. As managers have added more and more esoteric markets and short-term models, their implementation costs have increased more than any projected incremental alpha generation. Now, to go on, So here's our slide on volatility adjusted positioning. The green bars are volatility adjusted exposure of our 10 futures contracts at the end of July. The red dots are positioning at the end of June. Now we saw some meaningful changes last month. Starting from the left, we added long exposure in both crude oil and gold, likely helpful if tariff inflation kicks in. We've taken some currency risk off the table, more by adding to a yen short to hedge against a further dollar rally. On the rates front, we don't have much risk exposure. The seesawing view on rates this year has been far too unpredictable. And on the equities front, the portfolio is getting behind the rally in equities, especially adding long exposure to the S&P 500. As always, I'd like to remind you that these positions are quite dynamic. So if you're particularly interested in real-time positioning, it's best to check the website or reach out to Mike. Next slide, please. Here's our year-to-date contribution. As noted last month, the story this year is relatively simple. Starting on the left, we've made money in crude oil and gold. Our albatross this year has been our euro position, which we were short just before the euro spiked when Europe decided to rearm and Trump unleashed his Liberation Day chaos. But then it also cost us some returns when we were pivoted prior to the recent dollar rebound. So very frustrating, but just a reminder that this does happen to different asset classes over time. For instance, currencies were basically dead money for years before becoming the biggest driver of gains in 2022. Rates markets have also whipsawed several times, but losses were much more contained. And finally, we've made money in equities, which, despite the sharp drawdowns in April, have trended reasonably well this year. And with that, I'll pass the baton back to Mike.
Okay, thanks, Andrew. So let's wrap it up with long-term performance numbers for DBMF. Annualized returns since inception, including the month that was July 2025, is now 6.49%. That's ahead of the SocGen CTA index by over 300 basis points annualized and ahead of the Morningstar systematic trend average by over 425 basis points. And as Andrew just talked about, the expense ratio difference on the right does not include all the costs that you cannot see. So keep that in mind when you're doing your competitive analysis. And then long-term outperformance against the traditional diversifier for equities, that being bonds as represented by the Bloomberg AG, that remains well intact. DBMF is outperforming by over 530 basis points annualized. So thanks as always to our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.